Let's start with a simple question. When people say, "I bought a stock," what did they actually buy? Most beginners think a stock is just a number on a screen, something that goes up and down every day. But that's not what a stock really is. A stock means ownership. When you buy a stock, you are buying a small piece of a real company. Not a product, not a logo, not a chart. A real business that sells real things, pays real employees, and makes real money. If a company has 1 million shares and you own 1 share, you own 1/1,000,000th of that company. That's it. That's the core idea. Now, the next question. Why would a company sell pieces of itself to the public? Because businesses need money to grow. They need money to buy equipment, hire people, build products, and expand into new markets. They have 2 main choices: borrow money or sell ownership. Borrowing money creates debt. Selling ownership creates stocks. When a company sells stocks, it raises money without promising to pay it back. Instead, investors share both the upside if the company succeeds and the downside if it fails. That's why stocks are called equity. So if you own a stock, what do you actually get? There are 3 main benefits. First, ownership. You are a partial owner of the business. That means you benefit if the company grows and your share becomes more valuable over time. You don't need to manage the company. You don't need to work there, but you still participate in the results. Second, profits. Some companies share profits with shareholders. This is called a dividend. If the business makes money, you may receive part of it in cash. Not all companies pay dividends, but many mature companies do. Third, voting rights. In many cases, owning stock gives you the right to vote on important company decisions. For most individual investors, this is not the main attraction, but it is part of what ownership means. Now let's talk about the part everyone notices: price movement. A stock price goes up or down because of expectations. The market is constantly asking, will this company make more money in the future or less? If investors believe future profits will increase, they are willing to pay more today. If they believe profits will decline, they pay less. So stock prices reflect growth expectations, risk, confidence, and fear. In the short term, prices can be emotional. In the long term, prices follow the business. This is very important for beginners. Buying stocks is not gambling if you understand what you are buying. Gambling depends on luck. Investing depends on business quality, cash flow, and long-term growth. If you buy a stock without understanding the company, without knowing how it makes money, then it becomes speculation. But when you buy a strong business and hold it over time, you are letting the company work for you. If you remember only one thing from this lesson, remember this: a stock is not a lottery ticket. It is ownership in a business. Once you understand that, everything else in investing becomes clearer: valuation, dividends, risk, and long-term returns. In the next lesson, we will talk about why stock prices go up and down, and why volatility is not always a bad thing. This is the foundation. Understand ownership, and you are already ahead of most beginners.